In a highly anticipated move, the Federal Reserve has cut interest rates to their lowest level since 2021. The decision, announced on Wednesday, reflects growing concerns about the pace of economic growth and persistent inflationary pressures that have been weighing on the U.S. economy. The benchmark federal funds rate was reduced by 25 basis points to a target range of 1.00% to 1.25%, marking a significant shift from the previous rate of 1.25% to 1.50%. The Federal Reserve's decision to lower rates comes in response to a series of economic data points suggesting that the U.S. economy is slowing down. Recent reports indicated that consumer spending, which has been a key driver of growth, has begun to wane. Additionally, business investment has been sluggish, and manufacturing output has declined for the third consecutive quarter. The combination of these factors prompted the Federal Reserve to act decisively in an effort to stimulate the economy. Despite the slowing growth, inflation has remained stubbornly high, hovering above the Federal Reserve's 2% target. The central bank's dual mandate of promoting maximum employment and price stability has been challenged by this unusual economic environment, where inflation remains elevated even as economic growth shows signs of weakness. By cutting interest rates, the Federal Reserve aims to provide some relief to businesses and consumers, hoping to boost spending and investment. The Federal Reserve's decision also reflects broader concerns about the global economy. Ongoing geopolitical tensions, trade disputes, and uncertainties related to supply chain disruptions have created a challenging environment for global growth. The U.S. economy, although relatively resilient, has not been immune to these external shocks. Lowering interest rates is seen as a way to protect the domestic economy from potential spillover effects of global economic turbulence. Financial markets responded swiftly to the Federal Reserve's announcement. The stock market, which had been volatile in recent weeks due to uncertainty over the Fed's next move, surged immediately following the rate cut. Major indices, including the Dow Jones Industrial Average and the S&P 500, posted significant gains as investors welcomed the central bank's supportive stance. Meanwhile, bond yields fell as investors adjusted their expectations for future interest rate movements. The reduction in interest rates will have widespread implications for both borrowers and savers. For consumers, lower rates mean cheaper borrowing costs for mortgages, auto loans, and credit cards, which could stimulate spending in the near term. However, savers may find it more challenging to earn returns on their deposits, as banks typically lower savings account rates in response to cuts in the federal funds rate. The Federal Reserve acknowledged this trade-off, but they emphasized the need to prioritize economic growth. Despite the rate cut, the Federal Reserve faces significant challenges in steering the economy through this uncertain period. The central bank's toolkit for stimulating the economy is not limitless, and with rates already at historically low levels, there is limited room for further cuts if economic conditions worsen. Moreover, the Fed must carefully balance its efforts to stimulate growth with the risk of exacerbating inflation, which could undermine the long-term stability of the economy. In its official statement, the Federal Reserve highlighted the complexity of the current economic landscape. The committee is closely monitoring economic developments and will act as appropriate to sustain the expansion, with a strong labor market and inflation near its symmetric 2% objective, the statement read. The Fed also noted that while labor markets remain strong, the pace of job creation has slowed, and wage growth has been moderate, reflecting the broader economic slowdown. The Federal Reserve's outlook on inflation remains cautious. While the central bank acknowledged that inflationary pressures have been persistent, it also pointed out that some of the factors driving inflation may be transitory. Supply chain disruptions, for example, have contributed to higher prices in certain sectors, but these issues are expected to ease over time. The Fed remains committed to bringing inflation back down to its target level but recognizes that achieving this goal may take longer than initially anticipated. In addition to cutting interest rates, the Federal Reserve signaled that it is prepared to use other tools to support the economy if necessary. This could include further rate cuts, as well as additional measures such as asset purchases or forward guidance. The central bank's willingness to deploy a range of policy tools underscores the seriousness of the current economic challenges and its determination to prevent a prolonged downturn. The Federal Reserve's decision has sparked a range of reactions from policymakers and politicians. Some praised the central bank for taking proactive steps to support the economy, while others expressed concern that the rate cut could fuel inflation or create financial imbalances. The Fed's independence in setting monetary policy has been a point of contention in recent years, and the latest rate cut is likely to reignite debates over the appropriate role of the central bank in managing the economy. Early indicators suggest that consumer sentiment may be positively influenced by the Federal Reserve's actions. Surveys conducted in the wake of the rate cut show a slight uptick in consumer confidence, with many Americans expressing optimism that lower borrowing costs will help them manage their finances. However, concerns about inflation and the overall direction of the economy remain prevalent, suggesting that the Fed's move may not be a panacea for broader economic anxieties. The long-term implications of the Federal Reserve's rate cut are difficult to predict. While the immediate effects on financial markets and consumer behavior are evident, the broader impact on the economy will depend on a range of factors, including global economic conditions, fiscal policy decisions, and the trajectory of inflation. Some analysts warn that, if the economy does not respond as expected to the rate cut, the Fed may be forced to take even more aggressive action, which could carry its own risks. The Federal Reserve's rate cut has also attracted attention from central banks around the world. Many countries are grappling with similar economic challenges, including sluggish growth and inflationary pressures, and may look to the Fed's actions as a model for their own policy decisions. However, the global economy is highly interconnected, and the ripple effects of the Fed's move could have unpredictable consequences for international markets and exchange rates. Looking ahead, the Federal Reserve's future rate decisions will be closely watched by investors, policymakers, and economists. The central bank has signaled that it remains data-dependent and will adjust its policy stance based on the evolving economic outlook. While the rate cut provides a cushion against current economic challenges, it also sets the stage for potential future cuts if conditions do not improve. The Fed's actions in the coming months will be critical in determining the course of the U.S. economy. The Federal Reserve's decision has reignited the debate over the effectiveness of monetary policy and addressing the current economic challenges. Some economists argue that with rates already at low levels, further cuts may have diminishing returns and could lead to unintended consequences, such as asset bubbles or financial instability. Others contend that the Fed has little choice but to continue easing monetary policy to support growth and prevent a deeper economic downturn. The housing market is expected to be one of the sectors most directly impacted by the Federal Reserve's rate cut. Lower mortgage rates could spur increased home buying activity, particularly among first-time buyers who have been priced out of the market in recent years. However, with housing prices already at elevated levels, there are concerns that the rate cut could further inflate the housing market, leading to affordability issues and potential imbalances in the market. The Federal Reserve's decision to cut interest rates to the lowest level since 2021 marks a pivotal moment for the U.S. economy, as the central bank navigates the complex challenges of slowing growth, persistent inflation, and global uncertainty. Its actions will have far-reaching implications for consumers, businesses, and financial markets. While the rate cut provides a temporary boost to the economy, the path forward remains uncertain, and the Fed will need to carefully manage its policy tools to ensure a sustainable recovery. Small businesses are likely to benefit from the Federal Reserve's rate cut as lower borrowing costs could make it easier for them to access credit and finance expansions. This is particularly crucial for small and medium-sized enterprises (SMEs), which often face higher interest rates than larger corporations. The lower rates could also alleviate some of the financial pressures these businesses face, especially in the wake of recent economic disruptions. However, the effectiveness of this stimulus will largely depend on whether demand for goods and services can be sustained amid broader economic challenges. The Federal Reserve's decision is also expected to influence global financial markets, particularly in emerging economies. Countries with currencies pegged to the US dollar, or those heavily reliant on dollar-denominated debt, may experience increased volatility as they adjust to the new interest rate environment. Additionally, the rate cut could lead to further weakening of the US dollar, impacting trade balances and possibly prompting other central banks to consider similar easing measures. This interconnectedness underscores the Fed's role in shaping not only the US economy, but also the global economic landscape. Thank you for watching, and don't forget to smash that subscribe, like, and notification bell for more global finance breaking news.